Do you know what a surprisingly good business model is? Billboards. Those giant ads that take up space on the side of the road that people never look at. Well, it turns out that owning these brings in some pretty good money, and there are entire companies built on the idea of owning them. Today, I want to talk about how Boston Omaha is slowly building an entire empire using these simple roadside ads. Hey everybody, and welcome back to Dollars and Cents, helping you make sense of making dollars. Let's take a trip back to a time when Boston Omaha wasn't Boston Omaha, back to a company called Rio Plus. First founded as a result of one of the worst recessions in US history, the company started with a simple purpose in mind: buy cheap real estate. And for years, that's what Rio Plus tried to do, until 2015. That's when the Magnolia Group granted the company a large investment, but attached to this money was a board shakeup and a brand new name, Boston Omaha, among other strings attached to this deal. The newly revamped company soon invested a fraction of that money to form Link Media Holdings, buying $10 million worth of billboards across the US. Thus began Boston Omaha, and what makes this company particularly interesting. Link Media Holdings is its own entity, free to make deals as it pleases with little intervention from the main company itself. This way of doing business is very similar to that of another big-time elite company, Berkshire Hathaway. Berkshire Hathaway goes out and acquires a company like, let's say, GEICO, then just lets GEICO do its own thing, only acting as a holding company. Boston Omaha is set up in a very similar way. This hands-off holding company approach allows Boston Omaha to basically operate in any industry. This became apparent when General Indemnity Group started operations in 2015, primarily to acquire other smaller insurance companies. Plus, GIG acts as a commercial bond underwriter itself, specializing in surety bonds, just not only for Boston Omaha. Many investors refer to Boston Omaha as a serial acquirer. In other words, this company's entire mission is to make great acquisitions. Some other famous serial acquirers are the aforementioned Berkshire Hathaway, Constellation Software, and Roper Industries. Generally, this means that only one person is in charge of making deals, and that's almost always the CEO. That person acquires companies to create an extensive network of more companies to form one large mega company. But here's another example of Boston Omaha's interesting approach to business in that respect. There isn't just one CEO, there are actually two. In its 2015 shareholder letter, the company talked about this structure, saying both of the co-CEOs come up with their own intrinsic value for a potential acquisition. On top of that, it seems that the dual CEOs are fairly close with their valuations given the volume of acquisitions over the last few years. Here we see just how many companies Boston Omaha has acquired over the last few years. Of course, the most commonly bought assets are billboards and insurance. This also comes with large investments in real estate, particularly Dreamfinders Homes and its new branch, BOAM, or Boston Omaha Asset Management. With these acquisitions comes the expected steady revenue growth. It is important to note, however, that Boston Omaha's revenue was severely impacted by the pandemic. Highway advertising spending fell dramatically in 2020. Even now in 2022, it hasn't fully recovered. Plus, looking at free cash flow, it seems Boston Omaha has struggled to generate positive free cash flow over the last few years, not just during the pandemic. Interestingly though, it acknowledges that the value of a business is based on the cash flow it generates many times across its shareholder letters. And here you can see the amount of shares outstanding has gone up dramatically as well, although I'm not going to comment on this right now. We'll circle back to it later and you'll understand why when I do. Instead, I want to move on to return on invested capital, and again, with the profitability problem, Boston Omaha has consistently lost money over the last few years, and that has led to a negative ROIC. However, this is a complicated area. ROIC may not be the best thing to look at to gauge its success in this particular case, but we'll stick with it for now. A big area that Boston Omaha really succeeds in is its debt levels. While its EBITDA has been negative these last few years, it almost doesn't matter. The company has $390 million in current assets, $235 million of which is cash. This compares well to the measly $166 million in total debt. Boston Omaha can easily pay off all of its debt with just its cash on hand. Finally, Boston Omaha does not pay anything in dividends. This is good, as again, unprofitability is a sticking point. Overall, I think Boston Omaha's balance sheet is pretty good, though I do have an issue with the consistent losing of money. Despite that, on the surface, it seems like the company is moving in a healthy direction at least. That's great and all, but now I want to really drill down to the finer points of the company to actually learn more about its direction. And again, I think it boils down to expansion. Since the inception of the firm, its initial investment of $10 million into billboards, Boston Omaha has not only expanded vertically by buying more billboards, but also horizontally, adding different types of business to its repertoire. And at the forefront of this expansion plan is our co-CEOs Adam Peterson and Alex Rozak. If you invest in this company, you're essentially making a bet on them. The entire company up to this point has been the work of Peterson and Rozak. The expansion, the build-up, and any and all of the acquisitions fall on their discretion. As clear and obvious as it would be should they fail, it has also been evident when they have succeeded, and so far, so good. Again, I'll bring up Berkshire Hathaway because it relates in this respect too. Warren Buffett has been entrusted with investors' money for decades. If his decisions hit the company badly, he's responsible. If they go swimmingly, he's also responsible, just like Peterson and Rozak are for Boston Omaha. It was almost solely his job to make really good investments, and he did. As for Boston Omaha, it seems to be the case for its CEOs as well. Betting on a singular person can be super risky since anyone can misjudge or outright fail in any task. That is why I think the leadership structure of Boston Omaha is what will give it significant staying power for many years. There are two heads instead of one at work. In addition to the stellar co-CEO structure, Boston Omaha also usually entrusts lower-level acquisitions to specific people. Usually, they were appointed as the heads of the business's various parts. The evidence is clear with the aforementioned formation of GIG. GIG's president is Dave Herman, and he's been responsible for some of the 8 acquisitions made for Boston Omaha in the insurance segment over the last 5 years. In addition to having field-specific experts running various parts of the businesses, the co-CEOs are also responsible for these acquisitions and the investments themselves. Earlier, I said I'd visit shares outstanding. Long story short, they're increasing and issuing more. However, that's not necessarily a bad thing. Usually I'd be dismayed by the thought, but for Boston Omaha, it's actually quite simple. To fuel these acquisitions, the company issues shares. Really, public companies use two main methods of raising capital. It can issue debt by issuing bonds then paying back with interest over a period of many years, or it can dilute shareholders and increase the number of shares outstanding. True, your ownership stake in the business decreases, but it allows the business to have essentially free money to do whatever it wants. This second method is a very important way for companies to raise money, and there are entire sectors that rely very heavily on this funding method. Tech companies like Nvidia, AMD, and Block frequently dilute shareholders, and often quite heavily. The real estate sector almost entirely relies on this funding method too. Almost every single public REIT issues more and more shares every year to make acquisitions. While I normally don't like companies diluting their shareholders, I think it does make sense in some instances. Boston Omaha is effectively and intelligently using the capital it raises from issuing shares, and Boston Omaha has used those earnings incredibly well. In 2020, Boston Omaha entered a brand new line of business, broadband, after acquiring Utah Broadband and Airbeam. Then in 2021, Boston Omaha launched its own broadband service company called FiberFast Homes. The company is built on a pretty simple premise, and that is putting fiber-fast internet into new homes. Just 6 days after FiberFast Homes started, Boston Omaha then announced it was investing $10 million in a small home builder called Dreamfinders Homes, a small-cap home builder that recently went public. At the time, this made Boston Omaha the largest shareholder. Just days after this investment, Dreamfinders Homes and FiberFast Homes formed a partnership, which became its own entity owned by Boston Omaha. This new creation was named Dream Fiber Homes. Essentially, it's the joint venture where FiberFast installs fiber internet to all homes and communities built by Dreamfinders Homes. Talk about capital well spent from share dilution. But really, this simple investment and partnership is really what makes Boston Omaha such an incredible business. As long as the company can manage to form more of these incredible partnerships across its portfolio of companies, I think Boston Omaha will have incredible staying power for many years to come. And if you want to help increase the staying power of this channel, be sure to sub and like below. Of course, it's not all sunshine and rainbows with Boston Omaha either. Even companies who play their cards very well face some nasty, stormy weather from time to time. The largest and most obvious problem is Boston Omaha's continued reliance reliance on a singular revenue stream. Accounting for over 55% of Boston Omaha's total revenue last year, billboards are by far the company's largest source of income. Though Boston Omaha is working hard to decrease this reliance on the billboard business segment, it's hard to ignore the lack of diversity in revenue. Plus, such an over-reliance can prove detrimental to the entire business, like we witnessed in 2020. Given the unique circumstances of 2020, many companies saw cutbacks to advertiser spending in certain areas. Billboard advertising was heavily impacted. In 2020, outdoor advertising fell from over $40 billion in 2019 to under $30 billion or 2012 levels. It severely impacted Boston Omaha's generated revenue. Now, if you look at the 2020 annual report, you'll see that the billboard revenue fell by only $200,000. However, it's important to remember that Boston Omaha spent over $3 million acquiring new billboards. Also, it's important to note that despite another $20 million in billboard purchases, 2021's total billboard revenues haven't fully recovered. True, Boston Omaha has done a stellar job diversifying its revenue streams over the last 2 years, but more than 50% of that revenue still comes from billboards alone. Another potential problem I see is Boston Omaha's heavy reliance on management. Boston Omaha isn't exactly a product-oriented company. It relies almost entirely on the direction of management to continue to grow. That's not an outright bad thing, sure, oftentimes good things can come of that, but foisting all the company's business management on its two CEOs means relying solely on their abilities to make acquisitions and form partnerships. What happens if either Alex Rozek or Adam Peterson resigned? What if something happened that either or both of them couldn't perform their job to the best of their abilities? It'd be absolutely destructive to Boston Omaha. The company would need to scout a new CEO who could perform as good as, if not better than, Rozek or Peterson. This person would need to be an acquirer and partnership former. Now, I'm not saying that anything is going to happen. It certainly doesn't look like either CEO will be stepping down anytime soon, yet it's always a possibility. If I seem soft on Boston Omaha, where I'm usually more critical of companies, especially smaller companies, I really can't find any other major problems. But that's definitely not from a lack of looking. Rather, I think it's from a lack of other obvious problems that I can see. If you know of anything I didn't cover, I would love to hear about it in the comments below, because right now, Boston Omaha is looking like one of those near-perfect companies. So, the question is, will I be buying Boston Omaha? And the answer is yes, I will. Shocking, I know. As of right now, I don't own any shares, as I'm still nailing down a more exact value and figuring out what price I want to pay for the company. My primary way of valuing things involves comparing free cash flow to market cap, and that doesn't exactly work in this case, and given that fact, I'll take more time to fully figure out a valuation. If I assume profitability with a growth rate of 12%, I get a valuation of roughly $32 per share. Of course, that's just my temporary valuation for now. That could and probably will change in the future. However, I feel that the underlying business is solid, the direction of management is clear and focused, and the balance sheet is very strong. So, what are your thoughts on this billboard master? Do you think it has the potential to become the next Berkshire or HATHAWAY? Tell me your thoughts on Boston Omaha in the comments below, and if you enjoyed this video, check this video coming up on screen now. With that said, I'll leave you here. I'll see all of you in the next episode of Dollars and Cents.